The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
So the central banks control the primary interest rates in every country where these operate. And the assumption here is that most of them are kind of throwing in the towel on rate cuts. When we started the year, we just had a massive bet on 6 rate cuts by the Fed that would happen before the end of the year. And now, after this last couple of weeks, it's pretty well determined that if we get a single rate cut, that's about all we could hope for. When we turn around and look at what other banks, central bankers are doing bit by bit around the developed world, investors are concluding that we're just not going to see rate cuts this year. And these charts show how the projected final rate for the year, this would be the December meeting, has basically moved since January. And the trend is all upward. They're just no significant belief, or I guess there's hope, but there's no real confidence that we're going to see major bets for rate cuts. And that's primarily because inflation has remained much stronger than anybody thought. The assumption was that rising rates would slow the economy, which is what they've done in the past, but particularly our economy is no longer industrial dominated. And that's significant because industry needs to borrow capital to expand production. And today we are a technology dominated, service dominated, and we don't need to borrow as much money to expand business. We hire people, and it's intellectual property. But across the board, hopes for these steep cuts have been basically written off. And there's good reasons. First and foremost, while inflation is not as severe as it was last year, it just simply isn't falling fast enough to get to the Fed's 2% target. And now the concern is that they're going to abandon the 2% target and say, well, 3's close enough. And if 3's close enough, well, that's not good news for stocks or bonds. But we're getting some disinflation, and so this is kind of how the PCE measure has moved in the US since the turn of the century. We got really accustomed to no significant inflation, and then the COVID spike. So basically, while inflation here is back below the 3% level, it remains higher than we've grown accustomed to over the last 2 decades. Rate predictions are basically retracing the shift that came after the Federal Open Market Committee meeting that last month. And that's when Chairman Powell pleased the market by refusing to say that more hikes were possible. However, more recently, Fed representatives have been saying or implying that they're hiking the rate once or twice is not off the table if inflation doesn't come down. So basically, we have a wide realization that prospects for cuts haven't improved at all. And with the Fed's minutes and these speeches, the bias at least is to still keep rates high. And that causes volatility in the market as investors and particularly bond traders have short-term disappointment. Now, it's important to remember that higher rates are bad for bonds. So it may be that these bets on rate cuts have depressed the effective yield on the longer term rates. And when rates go up, that's bad for your bond values. And investors just often forget about the mathematics of the bond market. What's intriguing is the relatively muted effect the big shift in expectations has had on longer dated treasury yields. Since the Fed funds futures contract for this year's December meeting was initiated in June of last year, the 10-year yield has shadowed it very closely, and that's this area that I've circled right in here. Let me get my cursor back up here. This area, this correlation has been really tight between the world interest rate, that's WIRP, the world interest rate, and the Fed funds rate until recently. And when the 10-year yield is not rising as much as would have been projected. So here's what's actually happened with the 20-year Treasury exchange traded fund. This is basically we're in the 4th year of a bond bear market. And what this shows here is from 2020, March of 2020, that the 20-year Treasury has lost virtually 50% of its value because of the rising interest rates. In order for this to turn positive, we need interest rates to fall. So this is a particularly common long duration investment alternative. If we diversify the bonds into more durations and more credit quality, lesser credit quality than treasuries, we look at the Barclays aggregate bond fund. So diversification moderated the losses over the same time period. The loss is only 19%. But still, the point here is that bonds are typically the go-to safety valve for portfolio construction. If you work with a typical financial advisor or a website to set up your asset allocation, you go through a risk questionnaire. How much risk are you willing to bear? How much drawdown are you willing to take? How long before you're going to need your money? And a series of questions, typically 10 to 20 questions, and each answer has a point assignment. That point assignment then generates a portfolio of some percentage stocks and some percentage bonds, and the more risk adverse your answers were, the higher the bond allocation, disregarding the fact that we're now 4 years into losing money with the safe part of your portfolio. This is from Bloomberg, on the same index that I just showed you, the AGG bond index is currently experiencing the largest drawdown since its inception in 1976, both in terms of magnitude and the length of time. And the average, this aggregate bond index, actually when this chart was put together by Ritholtz just recently, the worst case scenario was minus 18%, and it's actually hit 19, but it's still down in double digits. But things could be worse depending upon what area of the bond market that you invested in. The 25-year zero coupon bond has actually lost 58%. So it is, let me use the word propaganda, that bonds are your safety valve. This is how you protect yourself against stock market declines, is by buying bonds. You have to be really careful. Even the shorter term 3 to 7 year bond is down almost 10%. And that's from 2020. I mean, this is year after year after year. Now, if you wanted an area that is a little bit more encouraging, it would be junk bonds. And this is the Mortimer Ferd. Who'd have thunk it that you would use the worst credit quality bond to provide some protection in your bond portfolio? But junk bonds actually provided the best diversification for long-term investors during this period of time, but you had to survive a 21% drawdown in the first quarter of 2020. You basically had to close your eyes, hold your breath, and wait for this bounce up. But given that same time period, this is only down 13% from the 2020 period. So as inflation falls, real estate should rise, and the real Fed funds rate was at its highest in 07 after the 22's all-time low. Rates cannot continue at these levels indefinitely without having an effect on the economy. I mean, that's the assumption that the Fed has. We raise rates, we're gonna force businesses to lay off people and slow production. We don't think of it in that terms, but that's their goal. If you're going to bring inflation down, you have to reduce demand, means you have to get money out of people's pocketbooks so they can't spend on anything. And if they can't spend, then employees get laid off and the economy will slow, buying pressure will subside, and inflation should come down. Indeed, as inflation is coming down, even though it's slowly, real rates are increasing. The rate after inflation. And if we define the real rate as the effective federal funds rate less the core CPE, consumer price expenditures, then it's now at the highest level since 2007. And at these levels, it's triggered recessions in the past, and it has flummoxed analysts that we aren't in a recession already. When we look at it this way, it's the monetary easing of 21 that looks to be the extreme outlier. The Fed's decision to hold off rate hikes until 22 begins to look like a historic mistake that can't be undone. However, well, this is a similar mistake that Paul Volcker had back in the 80s. I mean, he thought they whipped inflation and he started easing, and then he had to raise rates again. And that's what the Fed right now is. That's a mistake they don't want to repeat. But they made a mistake hiking rates as much as they did. It's understandable that the Board of Governors is anxious to not err as Paul Volcker did, and they're going to hold rates higher this time around. So here's the ratio of SPY to TLT. So basically COVID was good for stocks and was bad for bonds. That's what we showed you. The bond rates have continued to not protect you from market volatility, but have actually cost you money. The more conservative your portfolio, the more bonds you were forced to own by policy, and that's been very detrimental. This is a higher for longer investment world, and it's basically higher for longer is becoming an accepted fact. And the question is, how should markets treat it? So first, when rates are high because the economy is strong, we should expect stocks to beat bonds, and that is what they continue to do. Equity outperformance has persisted ever since stocks hit bottom amid the panicked atmosphere of the first pandemic lockdown. We look at this regularly by comparing performance between assets. And the primary one here is the SPY ETF, which is the S&P 500 exchange traded fund, compared to TLT, the 20-year Treasury fund. When the chart is moving up, as it is with this, I've added this extra trend line here, that basically means the ticker that is in first place is doing a better job of performance. Now, it doesn't mean that it's not losing money. It means that if it's a losing environment, it's losing less than the ticker that's in the second place. In this case, SPY has been winning over bonds without a doubt. Our chart confirms this continuation. If high rates slow down the economy, then this relationship should not be extended upward and to the right indefinitely. It's unlikely to do so. Real estate stocks are a typical defensive position because they pay a regular yield because of rental income. And the higher the yield on bonds, the less appealing real estate will be, and vice versa. The pandemic created other problems for property, but rates are a critical factor behind persistent, terrible underperformance by real estate investment trusts on both sides of the Atlantic. This isn't residential real estate. This is commercial, industrial, large apartment complexes, warehouses, shopping centers. This is a broad spectrum of real estate, which are owned and syndicated in exchange traded funds, in unit investment trusts, and mutual funds. But they have been losing value, just like bonds have. In both Europe and the US, they're significantly behind the major stock market index. In the US, that's the S&P 500, and in Europe, it's generally the Stoxx 600. So here I've charted the real estate from the same period. Well, it's close to the same period here, but real estate survived for a while, and it peaked here in December of 21. And since then, the real estate ETF, XLRE, is negative 28%. So you buy dividends or cash flow, and it doesn't protect you from a loss of value in the asset itself. That asset class continues to struggle. In 2020, there was an argument that low rates would help long duration stocks. Those are the stocks where the worth of the company's tied up in a bet on growing earnings far into the future. The point made back then was that low rates meant those future earnings wouldn't be so heavily discounted and the company would be more valuable. And basically, true to this theory, the Magnificent Seven tech giants massively outperformed the rest of the market, specifically the S&P 500, from the first wave of the pandemic until the Fed began to tighten rates. Then they underperformed with rising rates because the assumption was you could get more money now instead of waiting 5 or 10 years out to get the equivalent return. So since the beginning of 23, however, the Magnificent Seven have enjoyed more outperformance. Now, we've seen some of them falter a bit. So Magnificence has been as low as 4, then 5, but we put the 7 in the category. What basically changed that was the launch of ChatGPT in November of 22, and it's been more than enough to counterbalance the higher for longer rate scenario. The rise of NVIDIA, which is currently seen as the most direct beneficiary of artificial intelligence, has been central to this adjustment, particularly after, let's call it NVIDIA Day in May of 23, when it had blowout results for the first quarter that demonstrated there was real money to be made in artificial intelligence. And NVIDIA continues to be a phenomenon. When ChatGPT launched the Santa Clara-based chipmaker, was worth more than $2 trillion less than Apple. Now, 18 months later, I should say only 18 months later, it's almost completely closed that gap. The two companies are worth almost the same. Now, this basically illustrates that no company is impervious to higher rates forever or competition. Industry demands change. Investors appear to assume, however, that current trends will last forever. Wednesday, this last week, we had a lot of volatility in the market. Wednesday, the market was basically freaking out about rates. And then Thursday morning, before the market opened, we got bond friendly and everything got happy. It was kind of like a psych ward for a bunch of hormonal teenagers. And then Salesforce drops the most since 2008. I mean, it fell 20% on Thursday on the news that artificial intelligence projects are taking longer to land and harder to get. And everything turned red, and we got a massive bad day in the market. It blew up NVIDIA and Microsoft, who both are big beneficiaries of AI as they integrate into their business. Microsoft integrating it, and NVIDIA providing the chips. And it spread across the semiconductor. It really hurt the software part of the industry. Chip manufacturers, not so much. But the bright red on here is what happens when things that have been driving the market, in this case AI, go out of favor, at least for a day. Stocks have been driven up on the euphoria of artificial intelligence, NVIDIA and Microsoft, and CRM Salesforce basically get beat up, clobbered. The question is this a one day or a more significant event? Is AI now going to be looked at as no longer the next big thing? Well, when we take a look at market conditions, what those reactions are headline issues rather than underlying support for the market. So as of the market's close, this is the analysis from Asbury on the metrics of the market. While there's a high degree of concern over the volatility that we've recently seen is going to turn into a bear market, the underlying support does not seem to suggest that that's the case. There are some negatives, and there always will be, one of which investors are somewhat scared. They're negative when you see big drawdown days. It's fearful. But the trend in the S&P, the trend in semiconductors, the relative performance of semiconductors versus the S&P, large cap and growth continue to dominate. Volume is not all that bad. It has been below average lately. The internal Asbury 6 remains positive while it's shifted back, and price trends are supportive. So the fact that options traders are betting against the market is kind of a non-event, or should be from a strategy standpoint. Now, one of the things we've shown you with over time has been the Asbury 6 internal metrics of the market. And last month, this is where we were. This is basically neutral with the rate of change, relative performance against high yield, and investor flows, whether money is flowing in or out. And yet volatility was low, trading volume was okay, and market breadth was okay. And then not very much longer during the month, everything shifted positive. And then we got bad market breadth. And then we went right back to a neutral stand. This was on the 29th. And then on the 30th, volume traded back to acceptable levels. There's volatility in the market. And from a seasonality standpoint, that's not unusual for this time of the year. And as headlines drive the news around the presidential election and the Trump court case, and what will soon be various appeals. The headlines are designed to create fear, to make people come back to their news source so that the news source can sell advertising or subscriptions, one or the other. The issue that we run on in terms of portfolio is we're looking at recent market trends in our universe of exchange traded funds. And a month ago, this is what our portfolios look like. We do not use a client opinion for generating a client portfolio. That's what risk profiles do. You answer risk questions, and the advisor says, well, that question is worth 2 points, that question or that answer was worth 4 points, and that answer was worth 1 point. They get through all the questions and give your answers, and you get a profile. You basically tell the advisor or the website, this is how I want my portfolio structured. You're not asking for advice. You are giving instruction. We don't do that. We believe that risk is in the market. It is not in personal opinion. So this is how our portfolios were structured. Last month, we are condition adaptive models, and this is where we are today as of Friday's close. So the select portfolio is all broad indexes. Some of these are asset allocation categories. In global and dynamic, we actually have the ability to look at sectors and industries, but the portfolios are invested. We have nominal amounts of cash in the portfolios at the present time. And it does, when we see weeks like this last week, frankly, it does cause us to swallow hard a little bit. But we are invested because this is where the trends in the market are. We're not in the prediction business. We're in the interpretation business. Markets are dynamic and constantly changing. That's not going to be any different as we go forward, march through the end of this year, survive our way through whatever election outcome lies before us. Preserving your investment account and staying on track is not for slackers. Somebody needs to pay attention. Somebody needs to worry about it, watch, and act. And that's what we do for our clients. You can do this yourself. And when we figured out more than 10 years ago that Wall Street doesn't care about market drawdowns. Market drawdowns are part of buy and hold, and when you lose 25 or 30 or 50%, you're just basically supposed to grin and bear it and revisit your asset allocation, which unless you tell them to do differently, your portfolio is not going to change. You want to do this, and you need some cheap, inexpensive software. What we use for our primary tool costs a retail investor $30 a month, and you get all the information that we look at on our charts. If you don't want to spend the time learning, setting up policy, tracking, and acting, we're an option. You can hire us.